California just qualified a billionaire tax for the November ballot, 980,000 signatures. Norway already ran the exact experiment in 2022. The billionaires moved to Switzerland, and last month, Norway's own tax commission recommended cutting the rate back down. Here's what the actual numbers say on both sides and what it means for your state.
6 of California's billionaires left the state before this tax was ever on a ballot. Not after a vote, before one. Peter Thiel, who co-founded PayPal, the 2 men who founded Google, the former head of Uber, gone right around the first of the year. And when they went, they took an estimated $536 billion in wealth out of the state with them. That is close to a third of the entire billionaire wealth base of California walking out the door before a single ballot was printed. You probably felt something click reading that because you already know why they left. You have watched the cost of everything around you climb while the people at the very top seem to float above all of it. That instinct is not wrong. The frustration behind this tax is real, and the people pushing it are not fools. So I am not going to spend this video telling you the problem is fake. I'm going to tell you what happened when a country actually tried the fix all the way to the end, and then show you the part that should worry you about the version California is voting on this November. Here is why this one is not just another political fight. There is a country that already ran this exact experiment, that full national scale, for 4 years, and the results are in. That country is Norway. And 2 weeks ago, Norway's own government looked at those results and started backing away from its own tax. That has not happened before with a policy the political left actually won on. In the next few minutes, you're going to see what the tax did to Norway's books, why the side that won the argument is quietly unwinding it anyway, the 2 things on the California ballot that could cancel your vote even if you win, and the 4 signals that tell you whether your state is next. So did the tax work or not? The honest answer is the one that neither side will give you. And to get to it, you have to understand one strange thing about how a wealth tax is even calculated. A normal tax hits what you earn. A wealth tax hits what you own, whether you sold it or not. Picture a founder whose company is worth a fortune on paper, but is not yet making real money. In Norway, there was a man named Frederick Haga who co-founded a data company called Dune, and he got handed a tax bill based on what his company was supposedly worth, while the company itself was not yet turning a profit. That word, unrealized, just means wealth on paper you have not actually cashed in. And when the tax bill on your paper wealth can be bigger than the income you actually take home, you have only a few ways to pay it. Usually you pull cash out of your own business. Norway had just raised the tax on doing that too. So the people who could pack up and move did. Now here is the part the people defending this tax will tell you, and they are right about it, so I am going to say it plainly. Norway's total take from the wealth tax did not fall after the hike. It went up from 27 billion kroner the year of the increase to an estimated 34 billion by last year. And the reason is important. This tax does not only touch billionaires. In Norway, it reaches about 700,000 ordinary people, anyone with net assets over roughly $180,000. So even as the richest left, the enormous base of regular people kept the money coming in. If you stop the story there, the tax looks like a win. Revenue up, sky did not fall. But look at the piece the hike was actually aimed at, the top, and the picture turns over. The government projected the increase would bring in about $150 million a year from the wealthy. Instead, a professor named Ulla Jems Onstad estimated that the Norwegians who left took $54 billion in fortune out of the country, which works out to roughly $590 million a year in wealth tax revenue that simply walked away. Set the small expected gain against that loss, and at the margin it targeted, the hike did not make money. It lost it. Both things are true at once. The broad base grew, the target backfired. That is the honest answer, and now you can hold both halves of it. One name makes it concrete. Kjell Inge Ruka, one of the richest men in Norway and its single highest taxed individual, moved to a lake town called Lugano in Switzerland. His departure alone courts Norway around 175 million kroner a year in lost tax. More wealthy Norwegians left in that 1 year than in the previous 13 years combined. And Switzerland has a wealth tax too, which is the detail that gives the whole thing away. People did not flee to escape all taxes. They moved to a place with a better designed, lower, more predictable tax. The competition was never zero. It was a smarter version of the same thing. Before you decide Norway is just an outlier, look at the neighbors. 9 European countries have run a wealth tax over the last few decades. 8 of them repealed it.
Hey, real quick, just to jump in, if you're looking to start a business or buy a business, I got an amazing project for you. It's called the LLC Tips and Tricks Program. When these tax regimes shift, structure beats up speed. The LLC Tips and Tricks Program walks you through how to hold your own assets so the next tax code change doesn't take a bite before you see it coming. It's taught with myself and 2 rockstar corporate attorneys, and it is an amazing value for what we're charging. Links down below. Now let's get back to this video.
The one that should stop California cold is Sweden, because Sweden is the friendliest possible home for a tax like this, a high-trust country where people genuinely accept paying into the system. And even Sweden killed its wealth tax in 2007 after its richest citizens, including the man who founded IKEA, left. France ended its version in 2018. When the best case country cannot keep the tax, the country that just lost a third of its richest people before even voting is not the exception. It is the rule arriving early. So if Norway's government won re-election on this tax, why is it the one now walking it back? Here is the sequence because it is quiet and easy to miss. In September of last year, Norway's Labour government won again. The tax survived the ballot box, and the side that supports it declared victory. That is where almost all the coverage stopped. But the new finance minister, Jens Stoltenberg, the former head of NATO, had already ordered a review of every tax in the country. By December, there was a formal commission studying the biggest tax overhaul in decades. And on June 24th, 2 weeks ago, that commission handed down its verdict. Cut the wealth tax rate by as much as 75%. The country that ran the experiment, whose government won the vote on it, is being told by its own experts to retreat. That is the tale. Not a speech, not a repeal, a quiet climb down through a commission after the election was safely over. Which brings us to the state about to run the whole thing again, bigger and blunter. This November, Californians vote on Proposition 40, a one-time 5% tax on people worth more than about $1.1 billion, reaching backward to whoever was living in the state on January 1st of this year. Governor Newsom opposes it. He was offered a smaller 2% version to pass through the legislature instead, and he turned it down. So it goes to the voters as written. And now the part almost nobody is talking about. On that same November ballot, right next to the wealth tax, sit 2 more measures, Proposition 41 and Proposition 42, funded by an organization co-founded by 2 of the wealthiest tech figures in the state. One of them, Proposition 42, would ban taxes that reach backward in time, which is precisely how the wealth tax is written. Here is the trigger that matters in plain terms. If the wealth tax and one of those countermeasures both pass, only the one with more votes survives. So you can vote yes on the billionaire tax, it can win, and it can be erased the very same night by a measure that won by a little more. The money did not just leave. It bought an insurance policy against your vote before you cast it. So where does that leave you if you are not a billionaire and you are not going anywhere? This is where the outside view matters, because the story was never really about the billionaires. They are fine. They already left clean. Watch what Norway did next. In 2024, it bolted on an exit tax, a charge on your gains when you leave the country. You do not build a lock on a door that nobody is walking through. And an exit tax does not catch the billionaire who left years ago with a negotiated deal. It catches the merely well-off, the business owner 2 towns over who cannot afford a Swiss lump sum arrangement and now cannot cleanly leave either. The people who never get a vote in any of this are the state workers, the pensions, and the local services quietly budgeted against money that can move to Texas or Zurich on a click. When that base narrows, the hole gets filled the way it always does, with pressure on the income and property taxes that land on you. You do not have to take my word for any of it. Track 4 things yourself, and you will see the cascade before the news names it. First, whether Norway's parliament actually cuts the rate this fall the way its commission just told it to. Second, the California result in November, and then the count of wealthy departures in the 90 days right after it. Third, whether anyone in Sacramento floats an exit tax bill within a year of a yes vote, because that is the exact move Norway made, and it is the signal the trap is closing. And fourth, the next wealth tax bill member out of Washington state, because a yes in California becomes the template every other state reaches for. Those 4 data points will tell you whether this is repeating long before any headline says so. There are 3 numbers on that California ballot this November. 2 of them were bought by people who already left. Economic Ninja is officially out for now.